Budgeting money is rarely easy, but it's especially difficult when you don't have enough of it to even pay for all of your bills. You might be between jobs or simply have a job that doesn't pay well enough to address all of your expenses. Either way, it's important to change how you spend your money when you're so short on funds. Hi, I'm Nisha. As a seasoned business owner and a financial coach, I'm here to help women over 50 take control of their finances. Let's navigate the complexities of money together. Let's get straight to it. You can follow these steps for effective money management when you're seriously broke. Number one, be proactive and don't wait until the collection agencies start calling. They are relentless and aren't known for being understanding. They only get paid when you pay them, so you can see where their priorities lie. Call your creditors as soon as you can. See that you won't be able to make a payment. You might be able to work out some sort of an extension or get reduced payments for a while. By reaching out to your creditors properly demonstrates responsibility and willingness to address the situation, which can be beneficial for both parties. Many creditors appreciate when customers take initiative to communicate financial difficulties because it provides an opportunity to maintain good relationships and potentially recover the debt in a more manageable manner. By contacting them early, you can explore various options such as restructuring the debt, adjusting interest rates, or consolidating payments, which could offer significant relief during a challenging time. This mutual understanding can alleviate some stress and allow you to focus on regaining financial stability. It is also advisable to document all communications with your creditors, including the dates, the times, and the outcomes of the calls and the emails. Keeping a detailed record would not only help you stay organized, but also serve as a reference if any disputes arise or if you need to revisit the terms discussed. Additionally, approaching the conversation with a clear understanding of your financial situation, such as knowing your monthly income, expenses, and all the other potential changes to your cash flow, can facilitate a more productive dialogue. In some cases, you might also discover that certain creditors offer temporary hardship programs designed to support customers in exceptional circumstances, such as a job loss, medical emergencies, or natural disasters. These programs could provide temporary relief measures like payment deferment, waived fees, or extended payment plans. Exploring these options can give you breathing room necessary to focus on overcoming whatever financial hurdles you face. Number two, prioritize what's important and look at how much money you have available and pay your bills accordingly. Typically, your mortgage, basic utilities, insurance, and food will come first. Credit cards are usually last on the list, but consider the consequences of not paying each bill and make a decision. Do this step after you contacted your creditors. Your decisions might be different depending on their responses. Now is the time to ruthlessly cut all unnecessary expenses. Austerity has its time and place, and the time is now. So once you've contacted your creditors and gained a clearer understanding of your financial obligations, it's crucial to analyze their responses and adjust your plan accordingly. Some may offer temporary relief options such as adjusted payment schedules, reduced interest rates, or even a short term payment deferral. Whatever it is, we'll take it. Others might be less flexible, insisting on regular payments at a regular timeline. So, since you're armed with this, it's time to strategize your path forward. Your decision at this stage could influence the rate at which you can stabilize your financial understanding. So, consider prioritizing creditors who are less accommodating while ensuring you meet any obligations that preserve your credit score. As you assess your immediate financial situation, cutting unnecessary expenses become a top priority. Think critically about each expenditure and ask yourself if it is essential or merely a luxury. Dining out, subscription services, and impulse purchases should be first to face the cut. This process requires a practical and objective mindset where emotion takes a backseat to fiscal responsibility. The goal is to maximize the funds available to meet your needs, your essential needs, and creditor commitments. Number three is cut back on your savings plan, but do this for a short period of time, as short as you can take. This might be the one time to stop saving part of your paycheck. The expense and ramifications of not paying your bills might be too great to cut yourself even a shorter to make your savings payment. You've always heard to pay yourself first, but sometimes that's not appropriate. Once that emergency fund is funded, then start cutting. While the mantra pay yourself first is a fundamental principle in personal finance, emphasizing the importance of prioritizing savings, there are circumstances where this approach may not be advisable. In times of financial strain, such as an unexpected medical emergency, job loss, or an unforeseen major expense, the immediate focus should shift to maintaining essential living standards and ensuring that critical bills are paid. Missing payments on housing, utilities, or medical bills can lead to dire consequences, such as eviction, utility shutoffs, or escalated debt through interest and late fees. In such situations, it becomes imperative to reassess priorities, focusing on safeguard well-being and maintaining financial stability. Additionally, failing to meet mandatory financial obligations can severely impact one's credit score, thus affecting the ability to secure loans or even rent a home in the future. The longer term impact of neglected bills could also mean increased financial pressure as penalties and interest accumulate, further exacerbating an already challenging financial situation. In these times, assessing emergency savings, if available, to cover immediate essential expenses is wise. This strategy, although temporarily pausing regular savings contributions, protects against the spiral of debt and stress associated with falling behind on necessary payments. Ultimately, personal finance is about balance, adaptability, and foresight. The ability to recognize when saving is detrimental instead of beneficial underscores the importance of a comprehensive and flexible financial plan. By understanding nuances of financial priorities and adjusting strategies accordingly, individuals can navigate challenging times with resilience and emerge stronger with a clearer perspective on managing their finances effectively. Remember, it's all about taking small steps to create big changes. I'd love to hear from you. What are the things that you can do to increase your income? What are your strategies? Please drop them in the comments below and let's support each other. As always, I'm cheering for you. Until next time, take care.